Morningstar calls them a vulture of a value investor, rummaging through the rubble of distressed stocks. Barron's applauds them for having a sharp eye for finding well-financed companies whose assets are mispriced and whose stock prices are flagging. But most importantly, clients of Third Avenue Management agree that the company's motto, safe and cheap, is smart and rewarding.
Well, Third Avenue Management is an investment management firm based in New York City. We manage approximately $27 billion today. Our firm opened an office in Singapore just a couple of months ago, so we've started expanding our operations globally. But the firm was founded actually back in the 70s by Marty Whitman. Marty, who had been an analyst on Wall Street for his entire career prior to setting up his own shop, opened up an office with an assistant in New York. And some years later, we cleverly came up with the name Third Avenue Management because our offices were located on Third Avenue in New York.
Most of the time, we only buy in to common stocks where the company is extremely strongly capitalized. In the vast majority of instances, we buy at very substantial discounts to net asset value and by analysis, try to restrict those investments to companies where we think there are very good prospects that the net asset value will increase by more than 10% per annum, compounded over the long term. For us, the term risk is not very meaningful unless there's an adjective in front of it. We at Third Avenue bend every effort to avoid investment risk. That is something going wrong with the company or the security in which we've invested. But we try and buy at very low prices, and the lower the price, the greater the potential for gain. The lower the price, the less the investment risk. So our approach to risk is different than the conventional risk. Is one, we need to put an adjective in front of risk, and two, we don't believe there is a risk-reward ratio for us.
Our approach is unique primarily because of our safe and cheap investing philosophy. Safe at Third Avenue is three things. The first is a strong financial position. We only invest in equities of companies with very strong balance sheets, high-quality assets, and a relative absence of liabilities. The second component is competent management. We look for management teams with impressive long-term track records whose interests are aligned with outside passive minority shareholders. The third component of SAFE is understandable business. We only invest in businesses that we can understand after a thorough review of the financial statements. If we don't understand it, we just move on to something else. We're not at all benchmark focused. In terms of cheap and how that's unique, we look for a significant discount to intrinsic value or private market value. Others do that as well. Our approach, though, is much more balance sheet focused, as is all of our analysis. Our valuation methodology focuses on buying at significant discounts, often from net asset value. We really try to value companies on an as-is basis, and we're not as focused on valuing companies based on earnings or projected earnings as most Wall Street analysts are.
We like to take pride in the diligent research that we do on a company. We are not reliant on the sell side, Wall Street if you will, for the generation of ideas. We have a staff of now 23 investment analysts who work diligently to scour the globe for investment ideas and dedicate an incredible amount of upfront time diligencing and reading and learning as much as they can about the company, the industry that company's in, the competitors that company might have before we make an investment decision. So the upfront work that's done in the analysis part is tremendous. And then once that process is complete, there's if you will, a 360 review that takes place with the production of a memoranda about that investment idea, and then the presentation of that idea, both in writing and orally, to the rest of the team, so that the team who understands the philosophy that we practice here better than anybody can challenge that analyst on the investment idea so that we can have what I'll call a 360 review of that investment before it becomes a portfolio position.
We tend to run a very concentrated portfolio because we tend to invest in stocks in which we have high conviction. So that's really a byproduct of our fundamental bottom-up research. We tend to know the companies that we're investing in very well. And if you must diversify, or I take that back, if you don't know the companies as well as you should, then you must diversify. But diversification is really a poor surrogate for knowledge, control, and price consciousness. So we're not concerned about having 50 or 60 stocks in the portfolio. As a matter of fact, I wouldn't know how to handle a 60 stock portfolio. There's too much information. I would much rather have a 20 stock portfolio where I know those companies as well as or better than any of the analysts out there, and I can invest with conviction.
I think the most productive thing for us, and I dare say for AIC, is buy, hold, and you got the odds in your favor to prosper.